2015 saw fairly divergent outcomes for the Harmony funds. The first half of the year was good, driven by strong equity markets, and Q4 was also good as markets rebounded from a difficult third quarter. Most of the funds gained 2 to 4% in their base currencies during the fourth quarter. However, that difficult third quarter did impair full year returns for most of the funds. The funds performed reasonably well versus their long-term strategic asset allocation, but the absolute returns in some cases were somewhat disappointing. However, even during that difficult third quarter, the funds benefited from the underlying diversification that we maintain, be it by investment style, by manager, by asset class, and by currency as well. That paid off, and the funds experienced lower declines than their respective local equity markets. The European Diversified Fund delivered the strongest return, gaining over 6% in euro terms, supported by strong continental European equity markets, where the index gained around 11% in euro terms for the year. The sterling funds gained a little under 1% for both the balanced and growth profiles. The lower return there was reflective of a weaker UK equity market, which was down around 2% or so in sterling terms, underperforming most other developed markets on the back of a higher energy and materials exposure within the market, areas that have underperformed significantly of late. The Asia balanced and growth funds both fell by around 4% in US dollar terms over the course of the year. That's compared to a fall of approximately 9% for Asia ex-Japan equity markets. The US dollar balanced and growth funds were somewhat of a disappointment in terms of the overall return for the year. The balanced fund was down 4.2% and the growth fund was down 5.8%, both in US dollar terms, and underperforming their strategic asset allocation. The main drivers behind this were ultimately manager selection and also our diversification into global markets. Manager selection was a bigger driver of performance for most of the funds than asset allocation was. In terms of asset allocation, factors that contributed to performance across most of the funds included our exposure to Japanese equities and particularly to convertible bonds as well, both global and Asian strategies. In terms of detractors from asset allocation, we suffered from exposure to US high yield, which underperformed for the year, and also a small exposure to emerging market equities. In terms of manager selection, across many of the portfolios, it made a meaningful positive contribution, including in the sterling, Asian and European portfolios. In particular, we really benefited from the style diversification that we have within our equity components of the portfolios. So having exposure to growth and quality orientated strategies really benefited performance, particularly strategies such as Crux in Europe and Morgan Stanley globally. All of these strategies outperformed their benchmark by over 7% over the course of the year, which helped a lot in terms of performance, but also critically, it meant these strategies were up in dollar terms for the year. In terms of positioning, all of the funds have the bulk of their exposure in a range of high quality equity strategies, providing exposure across a diverse group of geographies and sectors. That's then balanced with listed real estate and listed infrastructure exposure. And then all of the funds have a degree of fixed income exposure as well, greater in the balanced profiles, less in the growth profiles. And within there, we favour global and Asian convertible bond strategies, high yield in the US primarily, and hard currency emerging market debt. It's a low growth environment, and that means low returns as well. But developed markets in general are still growing. The US is looking strong, and the rest of the world is also moving to a stronger footing as well. So with equity markets having corrected to the extent that they have, indeed global developed markets are back to levels they were last at towards the end of 2013, we think valuations look quite attractive from here. A lot of the bad news is already discounted. And actually, this looks like a good opportunity to be adding risk to portfolios. We think the key is for investors to stay invested at this point. Although there's an ongoing chorus of nervousness and fear, a lot has been discounted in markets already.